evening, board members. Dr. Flores. I wanted to share with you tonight some information that you've seen before and some new information as well to make sure that you're apprised of what we're doing in the district in terms of our history and projections, and also to make sure the community is aware of what's happening around Rock ISD. Several topics to discuss with you this evening. The first of which you've seen a number of times. This is our taxable property value trends. And you know that our property value growth has increased double-digit percentages in the last 3 years. And we've talked quite a bit about that. There's a lot of construction, a lot of new development happening in the area. But I think what's also very interesting about this graph, when you take a look at the trend, is the economic recession that lasted about 7 years. And during that time, the Fed funds rate did not change at all. But in Round Rock ISD, the only time that property values decreased was 1 year, and that was in 2010-11. And so I think that really speaks to the stability and the strength of this community, and both in terms of taxpayers and the business and commercial property as well. We do have a very large percentage of property in the district, almost 42%. That is something other than single-family homes. It's commercial property, it's business property, and multifamily homes as well. So continue to be a lot of development. But what this means is that the individual taxpayer does not bear a larger component when compared to other districts in terms of its tax burden. And you see that on this next slide. These are comparable districts in the Austin area. These are the 5 districts that surround Round Rock ISD. And of course, you know the commercial property in downtown Austin, and not really a very good comparison for Round Rock. But in comparison to, in particular, Leander and Georgetown being one of the 5 fastest growing cities in the United States, adding new individuals on an ongoing basis. But 80% of their property values are single-family homes. And so it takes a lot to raise funds. It takes a lot to generate revenue from the tax base. You see here our top 10.
I think that's an important slide. I don't mean to interject, but go back to that. I think you need to restate that, because I think, again, there's where some information that needs to be understood by voters as they get to the polls. Would you restate that?
Absolutely. I think it's a real partnership in terms of the business community and what happens in this district, but also taxpayers. And the burden on taxpayers in Round Rock ISD is less than it would be in one of the surrounding districts, simply because of the growth that we have and the new businesses that are coming on board and that have been here for a number of years. And you can really see that in this next slide with our top 10 taxpayers in the district. And this has changed quite a bit because there's been a lot of development. So the top taxpayer in Round Rock as of last year is Apple Computers. But they did a lot of development in the last couple of years, and that's why they have moved to the top of that list very quickly. They've added several buildings, several parking garages, a lot of new development in the area, and so this is only 6% of our property base is just these top 10 though. Tax rate trend over the last several years, you can take a look at that. It's been very flat. One thing to take note of it is in the bottom portion is the maintenance and operations tax. So in 2006, you're well aware that the legislature passed legislation that allowed districts or forced districts to reduce their tax rates on the M&O side by 1/3. And after that, it gave discretion for school districts to go back to voters in the form of a tax ratification election and ask for additional funds to help on the maintenance and operations or the daily operations of the school district. But as you can see here, the district has not taken that position. The board has not asked the community for additional funds in maintenance and operations. And there's several districts in the area that have gone back to voters and asking for that component. Focusing a little bit more on the debt rate only, you'll recall that in 2008, during the bond 2008, it was communicated to voters that the debt tax rate would be 34 cents. And as we got through some of the more difficult times with the economy and kind of stabilized growth within the property values, it was difficult to maintain that. And so we actually had to dip into the fund balance in the debt service fund to be able to keep that promise to voters. So I want to make that point. That was in 2010, 11, 11, 12, and 12, 13. 3 years in a row that we actually dipped into fund balance to help manage that tax rate and keep your promise to voters. So again, these are the 5 districts that surround Round Rock ISD. You can take a look at their tax rates and the comparisons. These are tax rates for 2016, 17. Round Rock being the second lowest out of those, with Austin just slightly lower. This is a slide that shows the debt service tax rate for those same districts over the last 5 years. It's a little bit difficult to see Pflugerville and Hutto, which is at the very top, because they're at the maximum tax rate of 50 cents. Hutto actually dropped their tax rate just a little bit last year. Leander, Pflugerville, Georgetown, Austin are all districts that have had bond referendums in recent years and have been selling bonds, just like Round Rock, because of their growth. But they are not ones that have actually dropped their tax rate. And so it is a balancing act to be able to be in a district that has a lot of growth in students and being able to manage that, but also maintain a very competitive tax rate along with that. And I think you can see from the graph of Round Rock in the black right in the middle, they tried to give back to taxpayers when they're available. You don't see that on the other lines up there. So now I want to introduce Mr. Raul Villasenor. He's with First Southwest. He's been the financial advisor to Round Rock ISD for the last 10 years, and he's going to talk through the next few slides.
Thank you, Randy. Madam President, ladies and gentlemen of the board, Dr. Flores, staff members. What we wanted to do just very quickly here, talk about the interest rate environment. And as you might expect, a lot of things happened in 08-09, but 2 things that impacted municipalities across the U.S. was borrowing rates, which became very, very attractive as the economy contracted. And you can see that if you'll follow the bars, the blue line is an index that we use to reflect borrowing interest costs if you were to issue bonds in any particular point there on the graph. The red line is the 10-year Treasury obligation, and as you can see, it's pretty obvious that the 2 track each other, except for when the financial crisis started back in 08 and 09, where they diverged because borrowing rates shot up immediately at that point in time, but Treasury rates went down. And the reason for that is because typically when you have that kind of situation occur, U.S. Treasury obligations are sort of the flight to quality. People want to invest more and more in U.S. Treasury obligations. But the negative side of this is the lime green line there towards the bottom, and that's the Fed funds rate. As you can see, as the Fed was trying to stay a step ahead of the financial crisis, you see that lime green line sort of ratcheting down all the way down to 0, or between 0 and 0.25%. What that did is it very negatively impacted municipalities' abilities to be able to reinvest idle cash balances. Now, idle cash balances occur with the simple mismatch of when you collect taxes or state revenues and the expenditure of those taxes and state revenues. In years past, municipalities would use those idle cash balances and the investments of those idle cash balances to finance projects. Now, they weren't large projects because you don't keep huge cash balances around, but they did give municipalities opportunities to fix roofs, do minor expansions. Pretty much all of that went away when that line dropped to almost 0%. So that took away one source of funds that municipalities typically would use to finance small projects. So again, the thing that continues to be very, very, very attractive for whether it's a bond proposition or the financing by whatever means of a major capital project is the borrowing rates. They continue to be very, very attractive. This line here sort of really brings that point home, because since 2006, which is that period of time right before the financial crisis, when the district was out borrowing money, we represent that borrowing rate as the true interest cost, which takes into effect all of the costs associated with borrowing the money. We were borrowing money in the mid 4% range and almost approaching 5%. But as you can see, after 2008 and 2009, as rates dropped, And what was very beneficial there is the policy decisions that the board was making at the time and the implementation of those policy decisions by Dr. Flores, Randy, and his staff really allowed the school districts to sort of follow those interest rates on their downward track. And as you can see, it's pretty obvious that we started borrowing again in that mid to high 4% range, and the most recent borrowing in 2016, I'm sorry, out of the 2014 authorization, that true interest cost borrowing rate was 2.63%. We expect that to continue. There's been a lot of talk about interest rates going up, but in the last 2 weeks, they've done the exact opposite of that. So we continue to, and obviously we're not here, you folks are not sitting in your places to try to determine where interest rates are going to go. I typically will tell clients, look, as hard as it may sound to believe, don't worry about interest rates. You need to borrow the money when you need to construct projects. Because I was around back in the early 80s when folks were borrowing money at interest rates in the 14, 15, and 16% range, and spent the first 5 years of my career refinancing all of that high interest rate debt. That's what happens when you borrow money in high interest rate environments. You take the first opportunity to refinance that in the same way that you and I might refinance our home or other high-ticket items that are our personal property. Assumptions. One of the things we wanted to clear up this evening is when folks see a large number for the bond authorization, sometimes they think, oh my gosh, you know, what are they going to do with that $500+ million? Well, first of all, we don't issue that all in one time. And the primary reason for that is because when we reinvest that money, we're not going to make hardly anything off of it. In the good old days, back way back, municipalities actually were able to build significant additional facilities by being able to reinvest those dollars when interest rates, as you can see by the lime green line all the way to the left, there were times there where that reinvestment rate exceeded what you were paying on the bonds. You didn't get to keep all of it because the IRS sort of got a hold of your excess investment earnings through the Tax Reform Act of 1986, but all that's gone away. So what we do now is we break up those large authorizations such that they are issued just in time to be able to finance construction draws. And by doing that, we minimize what we call, because that difference between the blue bar and the green bar is called negative cost of carry. So you're not earning as much as you're paying on the debt. So we don't want a lot of idle bond proceed balances just sitting around earning today, if you look at the Fed funds rate, under 1%, when the borrowing rate likely will be between 3.5% and 4%. So that's almost 250 basis points of negative cost of carry that we want to try to avoid. So we issue bonds in increments, again, to finance the facilities program of the district, and that helps us to align the borrowing with the capital needs. The other thing that does is it limits the impact on the tax rate. So if folks are seeing numbers that are generated assuming that all the bonds are issued at one time, of course it's not going to make sense, right? It's going to be difficult to accept the concept that this bond authorization is not going to require a tax rate increase. The way we get around that problem is that we issue it in increments. And so it impacts the local tax rate over some period of time rather than all at one shot. And again, the point that we've made already about the negative cost of carry is very, very important, something we didn't used to have to worry about, but we're very cognizant of that problem that's created for all municipalities, not just school districts. The other thing that happens is that unlike you and I, when we borrow on a mortgage to buy a home, typically those mortgages have one interest rate over that 25 or 30-year period of time. We don't sell bonds that way. What we do is we break up the bond, right, the amount of financing that you need at any one point in time, and we break it up into a series of bonds. In the case of Rock ISD, we will break up that bond issue, that first bond issue or that last bond issue, into what we call 25 maturities. Now, what does that do? Why would we do that? We do that because, again, if you remember back to Economics 101 and the time value of money, You pay interest, you pay more interest the longer you owe somebody money, right? As opposed to if you borrow a dollar from me, you're not going to pay as high an interest rate if I'm only going to lend you that dollar for a year. So breaking up those bond issues into these sort of individual little bond issues allows us to take advantage of what we call the yield curve, which again takes the time value of money and allows us to produce a lower true interest cost. Let's see. Yeah, the other thing that we're very careful to do, and you'll see it on I think our next slide, which is our busy slide that some of you have seen in the past, is that one of the things we do when the staff asks us to model the impact of bond authorizations, the first thing we start is, where are we at today, right? Because just like you and I, when we make a big ticket purchase, we want to know what our budget is. So that's one of our starting points, is what does the currently outstanding debt picture of the district look like, and for how much longer are the taxpayers going to be paying that currently outstanding debt? The other major factor in the calculations is taxable value. And as Randy pointed out, you folks have seen some dramatic increases in taxable value over the last few years. But part of the problem with showing taxable value increases, for example, if we show a taxable value increase from one fiscal year to the next and we say it's going to be 9%, everybody thinks their property taxes are going to go up by 9%. Doesn't happen that way, because if your particular property's taxable value didn't have any growth as assessed by your appraisal district, then your tax rate's going to be flat, right? But what we have to do is we have to take a look at the taxable value in its totality, which has its many components that Randy showed there up in the pie chart. And so don't be misled that when you hear that the taxable value growth is 9%, that it necessarily infers that your particular tax bill is going to go up by 9%. Okay? It just doesn't happen that way. It's the aggregate of all the properties that we're estimating will grow by some percentage amount. The other thing we've done in the analysis that you're going to see here in a minute is we've used what I believe is some very conservative estimates of taxable value growth. And further, we've only done it for 3 years. The one that we're real certain about, the coming fiscal year, that we're pegging likely will increase the local tax base by about 9%. But in the subsequent 2 fiscal years, we're only using a 6% growth factor, and then 0 from that point forward, okay? And the reason we like doing that is because I don't know, Randy doesn't know, you folks don't know what taxable values are going to do in 3 to 5 years, much less 20 or 30 years. And we would be really misleading you if we assume that taxable value growth extended out 25 years, which is the life of the bond issues that you folks will entertain. So I think we're using some very conservative numbers. Other school districts that we work with like to go out a little bit longer. Some go out 5 years in their projections. Few, if any, go out further than 7 to 10 years. So I think we're using a very, very conservative approach here. And the other thing is that where we can, we're going to try to sell bonds at their par value. Now, that sometimes doesn't always work because we've got to be able to obviously sell bonds wherever the market seems, happens to be on that day. But we certainly don't take advantage because, remember, under state law, you cannot go out and raise more money than was authorized by the voters, whether the bonds are sold at a premium, at a discount, or at par, as we've talked about here. Here's our busy schedule, and I apologize we have to show this to you folks, but what this does is, as we talked about here a few minutes ago, the taxable value is reflected in that second column from the left. And again, the blue numbers on the column that's right to its right, the estimated AV growth, and you can see there where those projections I talked about at 9%, 6, and then 0 for the balance of the years is what we use to calculate the impact of the bond authorization will be on taxpayers. Now remember again that if you don't have taxable value growth in your particular appraisal, then you're not going to see any sort of impact on this tax rate, on this bond authorization, excuse me. The next column over is where I indicated is where we start. We got to start knowing what the taxpayers owe today, right? Because if we ignored that, then we wouldn't be accurately reflecting the tax rate on the far right-hand side. We're expecting that when the bond authorization is approved, that we will sell those bonds in 4 different increments, 4 different sales. And those, again, are intended to track the construction that your facilities department can manage, right? Because there's a limitation there. And so we expect that, again, those 4 sales will occur between 2017 and 2020. Now, the other thing that does is certainly if we were to have another financial crisis and we saw taxable values going down, the board will have the prerogative whether it wants to continue on this course or not, right? And so that's an option. May not be one that we all might like, but it certainly gives the board an opportunity to react to economic conditions. And a lot of that happened, let me tell you, between 2008 and 2012, where school districts sort of stepped back, particularly those that had dramatic drops in taxable value, because it would be silly for them to try to continue to build facilities. If taxable values are going down, it's likely that families aren't moving into your school district, and it has a lot of implications that sort of allow you to sort of back away. Might not be for long, but for a year or 2 or 3 from continuing to finance or expanding or improving your facilities. The other thing we do at Rock ISD, and this is again a board policy that the board established many, many years ago, is we try to ensure that all technology expenditures that are included in the bond issue are amortized over a 5-year period. And so when you look at the numbers in the 4 bond sales in the middle of the graph there, or the information there, you'll see some higher bond payment numbers in the first 5 years, and then they level off for the balance of that amortization schedule. So that's an indication to you that that's where we're paying back technology-related expenditures, excuse me, it looks like the majority of them here happen, maybe some in that first sale, but pretty much in the next 3 sales. And again, that was a policy decision that the board made because you certainly didn't want to put the board in a position, and the staff, quite frankly, that you were amortizing computer systems over a 25-year period. So I think that was a good move that the board made some years back. So all of that, again, just like we would in our household budgets, we're adding all these numbers all the way across, and let's focus now on the last 3 columns on the far right-hand side. So with the authorization of the bond issue and the 4 separate sales between 2017 and 2020, you end up with the estimated total net debt service. And the reason we have to say estimated is because we have to make certain assumptions with respect to interest rate. And those are also reflected in the column headings above each of the amortization schedules there. And so then here's the sweet spot. What happens to the tax rate when the voters authorize $572 million and change in bonds? And that's the impact you'll see on the last 2 columns. Now, part of that is coming from the fact that you had a very, very healthy and growing tax base since the financial crisis, as Randy presented in that one graph. And so that's going to help you tremendously going forward, right? Because just like you and I in our household budgets, debt service typically tends to drop down as you're amortizing bonds every year, and you can see that when you go back with that starting column there, the 4th column from the left, all the way down to where the basically debt service will go to 0 in 2042. And so what's happening here is that 2 things, I think. One is that we are not assuming that all of the bonds are issued at one time. Otherwise, you would see a dramatic impact in the tax rate, right? Secondly, we actually use some very, very good estimated interest rates on the bond issues that we're reflecting in the middle part of that information. And so and those interest rates are conservative. As you can see, if you look at the bottom of the green part of the column headings, we used 4 1/4, for the 2017 bond issue, and then 4.50, 4.75, and 5%. That's on a TIC basis. The bond issue that we sold in 2016, you saw on that prior slide, was sold at a 2.63%. Now, we're probably not there anymore, but we're not at 4.25. So what likely will happen if we stay on this track is that it's more likely that you would see the interest and sinking fund tax rate go down rather than going up, particularly if you continue on that very, very healthy growth in the taxable value. So again, there's no smoke and mirrors here. All of the calculations that are done that support this particular spreadsheet are supported by a bunch of other spreadsheets, as you might expect. Mr. Staats and his staff have access to that information. We could lay it out over, 1 or 2 football fields and provide the level of detail that might be necessary for folks to clearly see that if the numbers folks are running don't appear to work out, there's probably a problem with their numbers. Many of you who know me know that I've been doing this this coming July 35 years, and no one has ever run me out of a school board meeting because I gave them bad numbers. We spend a lot of time, because remember, I have a fiduciary responsibility to the board and the taxpayers. And so we spend a lot of time going back and forth with your staff, reviewing assumptions, reviewing interest rate projections. We believe that those interest rate projections are conservative, meaning they're probably higher than we'll probably get. And again, we're here to answer any questions that the board members might have.
Well, I have 2 questions. Do you want to finish the presentation, or do you?
This slide, I was having this conversation with Randy the other day when I was in my office, and if you have a printer at home, print this out on a 11 by 17, all right?
I do it on ledger paper.
But this is the one everyone should carry in their pocket.
Right.
These numbers don't lie. I want to go back to 2013 bond, $299 million. We, as a board, when we went to the community to ask for that bond package to be passed, we said the tax rates were going to go up because we used some of these no growth projections, and we just kind of kept everything flat. But what happened after we sold the bond? What did the tax rate actually do?
Well, I think in our assumptions, just to be clear, is we were coming. That was in the spring of 2014. We were still coming out of the economic recession, and so at that time we didn't even know what our certified values were going to be for the next year, and so we had projected actually 3% for about 3 years in there, and so we were even more conservative than we are now. But we had projected a 2% increase in the debt tax rate, and we've actually come down considerably since then, about 3 pennies.
So, I don't want to end up on TV like Chad, so I'm just, all I want to say is.
Online, not on TV.
But this particular document, we have, there's folks who are going to say, look, this may not be the right time, whatever that may be. But anyone talking about any dishonesty when it comes to the debt service and what is being collected, it just doesn't jive. These numbers don't jive with some of the numbers that are being talked about. And I feel to respect the individual voter, and they're the ones who are going to make that decision when they go in that voter box. But to go into that box to vote on misinformation is not right for, they're missing something. But this document here, this is the one I keep in my folder on a big ledger. It's the one that everyone should keep in their pocket. If there's anyone talking to them, if their neighbors are talking about it, this is a great document. And Randy, the numbers over the years that I've been part of the board and watched over the years prior to being on the board, the district has not failed me as a taxpayer. So thank you.
And I've been telling folks that if they want to sit down and have a conversation about it, I'm more than happy to make time and sit down and talk this through and make sure they understand what they're looking at and what the information entails.
Thank you. Mr. Chadwell.
Yeah, make a comment kind of similar to that. Is I do, and I've been kind of watching the online dialogue and hearing about the questions it raised, and I'm trying to figure out. And I think what we just went through that. All of this money doesn't get piled into our existing fund balance and it doesn't set this number up. I can understand people objecting to maybe some of the things in the bond. The bond committee came to us, I think, with a $530 million number is what it was. This board, the first time we heard that, we said we want 590 or something like that. We finally settled on 572. This district still has a lot of things that are on the wish list, and we keep pushing them out. The bond in 2014, we used to call that, or we did call it at one point, the bridge bond. Just let us hold it. This will hold us over until we figure out what's going on with the economy. I don't mind people objecting to some of the things in the bond, whether we're using computers or we're using organic training or learning. We're still doing all of that. But when somebody comes out and says that the district is lying and lying with their numbers, if they say they don't understand it, I can accept that. But to say that the district is misleading is a question to everybody in this community. The city of Round Rock, the city of Austin, the Travis County, Williamson County, this growth that's going on, this extra growth. The 9%, I was thinking about that too. Maybe people are thinking that their tax rate will go up 9%. But a lot of the growth that's coming from, the taxable value that's coming from this is new homes and new businesses that are moving in. People are still moving here. As Councilmember Morgan just mentioned a minute ago, 15th and 16th were number 15 in the school district in the city. People are moving here and still moving here at a pretty healthy rate. Alvin Langford, the chief appraiser for Williamson County, said 6,000 and 6,500 homes were built in Williamson County last year. And that's not counting Travis County. So there's a lot of growth and new growth. So I'm glad you pointed that out, saying that your tax rate will not go up 9%. A lot of that is spread out over the new growth, new additional facilities, buildings, and commercial property, which you showed earlier, commercial property being 28% or whatever it was. So I thank you for putting this together. This award that you won a few minutes ago was at least recognized as general financial. That's Canada and the U.S. The board didn't give that to this their finance department. That was your peers across North America that gave that to you. So again, this district, as you said, Mr. Tisch, Round Rock has not let us down, has not misled us. I applaud you for being very conservative in your numbers. I applaud the boards before I got on, for being very conservative in how we handle these. So if anybody does have a question, I hope they call you, Randy, and I hope they call you, Dr. Flores, and or call me. But to say that we are misleading intentionally is I think it's an insult to all the voters here who over the years have supported this school district and created such a great ecosystem here, a great partnership between all of the entities that are here. So thank you.
Well, and I'd like to talk through what this means to the individual taxpayer. So at the bottom right-hand side of the screen, you see that that's the maximum tax rate, and that's not until 2020, and it's 0.3026. And so if you carry that across, and we'll focus just, this gives you kind of a 5-year history, but I want to focus on just two columns here. So if you look at 2016-17, at the very top you see the M&O tax rate of $1.04, and the current debt tax rate of 0.2925 for a total tax rate of 1.3325. And then we try to demonstrate for you, if you're a $100,000 home, what does that mean to you? Or if you're an average, if you own a home in Round Rock, that's an average taxable value. That's after the exemptions have been applied. So that's $264,752. So if you add back the 25, that's the 290 that's been reported and shared with folks. And so that calculates out into the bottom. That shows you a total tax there. And that is compared to, on the right-hand side in the green, the only change in that column is you change that 2925 to 0.3026, which is the third year potential tax rate increase. And that shows you the difference between the 2016-17 year and 3 years later with the tax rate. That's how we calculated that per month impact. But it is important to note that if your home is not an average home, either higher or lower, that the impact would be different. And if you have changing values, the impact could be different. And that really depends on you all as board setting the tax rate in September after we have received certified values from the appraisal districts.
And I will follow up on that. I think there is room for some differences, some expectations. As you all said, we don't know what's going to happen with the the economy, the tax rate, what they're going to set, but it's not going to be a factor of 10x or 12x that I've seen some people putting out there. It might be a few percentage points different, but that's the part that is startling to me. Thank you.
And this is just kind of a more animated version of trying to communicate that monthly impact. So I want to talk with you a little bit. We had a really great question at one of our bond forums, and the individual had asked, what happens if your projections are not realized? And you heard Mr. Villasenor talk about, how conservative we are in the interest rates that are considered in here, but also in the property value growth. And so I think that's the first piece is we're always conservative in those estimates, hoping that we'll never reach that. But there are some other debt instruments that could be utilized aside from fixed rates, which is our customary bond. Several years ago, you allowed us to use variable rate bonds, and those have been very effective for us. We were able to sell more bonds to move forward with more projects at that particular time. So there's a lot of different types of debt instruments and possibly some different structuring on the debt that we could entail if something were to occur like that. We also have the ability to postpone the sales and the related projects to a different time period if we needed to wait a little bit longer because something happens in the economy. And then again, as we mentioned earlier, we actually used the debt service fund balance 3 separate years for a total of over $10 million to maintain that stable debt tax rate that was promised to voters during those trying economic times. So I want to just emphasize that you were able to keep the promise that you shared with voters back in those times. So just talking a little bit about the strategies for managing debt, recall that the state statute in Texas allows you to sell bonds up to a maturity of 40 years. In Round Rock, we've never sold a bond greater than 25 years. And so you think about it, you compare that to an individual that buys a home, and a traditional mortgage is a 30-year mortgage. So in Round Rock, we're paying off a much larger, much more expensive facility in a shorter period of time than an individual pays off their home. And so that's what creates that rapid repayment of debt. 56% of principal and interest is paid off in the next 10 years. It's a much more aggressive repayment schedule than a lot of districts. But also included in that is that technology that you heard Mr. Villasenor talk about just a moment ago. There is a much more rapid repayment of that debt as well. Then we've looked at some different alternative financing instruments in the past, done 4 different refundings in the last 10 years. And several years ago, long before there was a law that required it, the district had a debt management webpage to communicate information about the district and be more transparent about that. Certainly financial performance you've heard a lot about this evening. And you have also adopted a fiscal and budgetary strategy that was very proactive and really, kind of set the tone for our conversation with the credit rating agencies to get us where we are today. But part of that is establishing a minimum level of debt service fund balance as well. When comparing ourselves to the 3 largest districts in our area, Austin, Leander, and Pflugerville, but also our peer districts, which were in Houston and Dallas area, if you take a look at the column that shows debt per student, which is the second from the right, you can see that the debt per student is the second lowest in the region. And we could certainly be lower if we had a higher tax rate. So if you look at some of the other tax rates on the right-hand side, you see 39 cents, 50 cents, 38 cents. There is the ability to pay down debt sooner and have a lower debt burden, but it does cost the taxpayer. And that goes back to that balance that we were talking about earlier. Now let's talk just for a moment about oversight of bonds, because in 2007, the board wanted to start a committee that would provide some oversight for the bond proceeds and the projects that are associated with those. So that's been in place for over 10 years. That committee meets quarterly and provides updates to you all, as you know. And they have an update for you later this evening as well. Quarterly financial reports, which will be another one this evening. And the annual financial report is audited by an external CPA firm that's required under Texas statute. Independent group that comes in and has a very objective perspective, takes a look at debt, takes a look at revenues, expenditures, and how we post things in compliance with governmental accounting standards. One of the requirements under the first report, the Financial Integrity Rating System of Texas, which is issued by TEA, is to ensure that you're making timely payments of debt, and that does have an impact on the rating. And then about 4 years ago, we were actually audited by the Internal Revenue Service with regard to one of our bond issuances. And they took a look at a lot of the information that we shared and only had two minor recommendations for us and actually gave us a very favorable report. As a result, we actually started documenting some of our procedures a little bit better. And we sign off on those, indicating that we've completed that. In terms of credit ratings, as you know, Round Rock is the only district in the state that has a AAA Fitch ratings. We're one of 7 that have a Moody's rating, but those two combined makes Round Rock one out of 1,019 school districts in the state of Texas that have a AAA rating for both Moody's and Fitch. And the reason for it and what the credit rating agencies are looking at is the economic growth of the area. What is the property taxes doing? What is the new construction and build out? And what is the future growth in the area as well? But it also takes a look at financial performance and looking at your reserves and ensuring that you have a sufficient level of reserves. And of course, the written policies and the leadership from the board in terms of adopting the fiscal and budgetary strategy is a component of that as well. So in the conversations and in the meetings with the credit rating agencies, they get a lot of data from a lot of different sources, and they ask a lot of data of us. We have some lengthy conversations. They pose a lot of questions that we need to respond to. And in December 2015, we were actually able to persuade them that we should be the only district in the state of Texas to have that rating. So I think that's the last slide we have for you this evening. I'm happy to answer any questions, or if you have any questions for Mr. Villasenor as well.
I did want to mention one thing, that fiscal and budgetary strategies, when we did that, it became kind of statewide. There were a lot of districts that we were, I know that Tracy Hoke and yourself, it's Ginsburg now, but all mirrored that same strategy across this state. So again, there was a leadership opportunity for Round Rock out there that's been well recognized.
Yeah. In fact, I think the wording is exactly the same in other districts.
It is. I actually got a phone call one day and said, how did this all happen? And they're exactly the same. So congratulations on that. Mr. Moses.
Thank you, President Cox. And just as a quick comment for Mr. Villasenor and First Southwest, it really isn't, it's more a comment, but just, I know we up here know the understanding of the word fiduciary and what that means, but those of us, I'm in the financial services industry also, and so just that's a very serious word when it comes to responsibility to your client in doing what's best for them and in their best interest. So I think that's a word that not just this board, but it is something that our community members should take very seriously in the heart, that the work they do is in the best interest of us, their client, the district, therefore in the best interest of the citizens. So when they make these projections, they're doing it because, and giving us those numbers, be as accurate as they possibly can, which I think is, you should be commended and thanked for that.
Mr. Chadwell.
I will say, again, thank you for the note about the Texas and putting that in red about the only one Fitch. You know, we self-titled ourselves a destination district, and we've self-titled ourselves as a world-class district. We gave ourselves those titles, and going across the district, you can see school districts, they label themselves, you know, we're innovative, and of course we do that too. But again, these recognitions, the one that you got earlier for your department, and these credit agencies, that's not us. That's not the board. That's not the administration. That's not you guys. You're presenting the material, and they're giving you that rating, or they're bestowing that. I also want to comment, so congratulations on that, and I did not realize that you were the one that set the pace for the rest of the state, so thank you for doing that. So that's great. The other thing I want to acknowledge and comment on is the oil and gas business. You know, we all read in the paper on a fairly regular basis about the price of oil. Is it going up? Is it going down? The answer is yes. It's just how much and which direction. And we all know people, and I know Mr. Tisch, you go all over the state of Texas. You probably go through the oil patch, and Ms. Cox, and everybody on here probably knows people who live in the oil patch when it was $100 a barrel and they were just rolling in money. And they were building things, they were building schools, and they couldn't build houses and apartment complexes fast enough because the people were moving in. Now the bottom's fallen out of that. It's at $50 a barrel or whatever. It's dropped. And so we're very, very fortunate to be here, that we have a very stable economy. We have a lot to be, you know, it'd be great if we had lots of oil and gas revenue to live off of, but that goes both ways. So, you I just think that there's a lot that goes on here, and there's a lot of infrastructure that's been put in place intentionally that we, all of us here in this community, the city of Austin, Travis County, Williamson County, city of Round Rock, the MUDs that are all part of it, we all benefit from it, and we all work very cooperatively. So we have a lot to be grateful for, and I realize that there's some uncertainty with the the interest rates, or some uncertainty with how much things are going to cost to build in 3 years or whatever. But we have to go forward. We can't wait. We can't let these roofs continue to leak and the floors, and we have to invest in technology. So thank you for putting this information together.
Thank you.
Dr. Flores.
Yeah, I just want to commend Mr. Staats and his staff for an excellent report, Mr. Villaseñor as well. Since I've been superintendent in October of 2013, we've had several superintendent reports. Community of Round Rock ISD, I don't think there's more timely and more important and a more thorough report than what was given tonight. And what you saw tonight is a legacy that's been left by Mike, these names, let me throw some names out. Mike Jolly, Tracy Ginsburg, Ramiro Flores, Randy Staats. These are not people that, one, to taxpayers, they don't like to spend money. Sometimes they offend principals. Sometimes they offend the superintendent. But let me say this. I always come back and say, you bet we're going to do what Randy Staats in this finance department. I've said that when Ramiro was here. I've said that to you. And the reason that's important is because that's why we are Round Rock ISD. So again, thank you for a thorough report. And Madam President, this report not only is timely, it's purposeful, and it does allow, we cannot advocate for a bond. We cannot say yes or no. We can't tell voters how to vote. But if they have questions about how to vote because of finances of Round Rock ISD, they need to submit 40 minutes, or we can submit this 40, maybe a little longer than that, Randy, but nonetheless, 40 minutes well worth spent for someone to be educated in their voting at the box, hopefully on May 6th or April 24th through May 2nd in early voting. Thank you, Mr. Staats.
Thank you.